Go.
Hi guys, my name's Don Simber. I teach Accounting 1 and Accounting 2 on campus. I used to teach small business management on campus. I teach film directing online, and I teach what I taught embalming 2 online. So obviously I will do the accounting board review. I will also do the small business management review, which will include some basic computer review at the end. The computer stuff is basic stuff that you probably take for granted that you know at this point, just by everybody having a computer, a tablet, a phone that has all these things. So we'll do that at the very end. That's not included in the packet, primarily because it was only a glossary and some questions out of a conference book. So I will not go over it. I'll go over that, informally. I suggest we take a break about halfway through just to catch our breath, because it is accounting. You say debits, you say credits, you get it gets a little, you feel like your head's spinning at some point, so I don't want that to be the case. And the place I usually take a break is a good spot, because after that break is where we really get into the most challenging part of the curriculum for Accounting 1 and Accounting 2, which is sales and purchases accounting. So that's a good spot to take a little break. So let's begin. If you have any questions, feel free to stop me. The assumption is that you do know this, but at the same time it moves much better with the answers there. I was in your shoes not too long ago, only about 5 or 6 years ago, and I went through this whole process, and the ones that had the answers are a lot easier to go through than the ones that didn't have the answers. So they're there for you, but if you have questions, certainly ask them. Okay, number 1, what is the accounting equation? Assets equal liabilities plus owner's equity. Number 2, how do you increase an asset account? It's a debit. How do you decrease an asset account? It's a credit. How do you increase the liability account? Credit. How do you decrease the liability account? Debit. Number 6, what type of balance does the cash account carry? It carries a debit balance, as do all asset accounts. Number 7, when you receive a cash payment, what must be done to the cash account? You have to debit the cash account. When you pay out money or write a check, what must be done to the cash account? You have to credit the cash account. What type of balance does an expense account carry? Carries a debit balance. All expense accounts carry debit balances. When you pay a bill, what is the entry? When you pay any bill, you debit the expense account, the corresponding expense account, and you credit the cash account because you're actually paying cash. Other terms that may be used for revenue account are revenue, sales, and fees. The difference between total debits and total credits in an account is the account balance. An unwritten promise to pay creditors for property such as merchandise, supplies, or equipment purchased on credit, or for services received on credit, is accounts payable. (14) What is an unwritten promise to pay at a later date for goods sold or services rendered? That's an accounts receivable. 15, what is another term for the book of accounts? That's the general ledger. 16, there's a typo. It should say, what is the book of original entry? And that's the journal. Another catch term that you might see is chronological. A chronological book of transactions, but a book of original entry is technically the definition you would see in the glossary for a journal. 17, what are the debts that are owed by the business? Those are liabilities. 18, property value owned by a business, assets. There's 2 19s. What is the abbreviation for credit? Capital C, lowercase r. The abbreviation for debit, capital D, lowercase r. Number 20, name the 2 temporary accounts that will appear on the trial balance until they are closed out. Those are expenses and revenue. They are the temporary owner's equity accounts that will appear until they are closed out at the end of each financial period. 21, the order of the accounting statements is the trial balance comes first, income statement, statement of owner's equity, and the balance sheet. Please note that the only informal one is the trial balance. All the rest are considered formal. 22, formal financial statement illustrating the assets, liabilities, and owner's equity of a business as of a certain date, balance sheet. 23, the statement in which the equality of debits and credit balances in the ledger is shown is the trial balance. So the trial balance is used to prove the ledger. The difference between the balance sheet and the trial balance, you could read that for sure as a review, but the trial balance is your first financial statement. It has everything on it. You're proving the equality of the ledger. When you generate the balance sheet, which is after the income statement and the statement of owner's equity, you will have closed out your temporary accounts for that financial period, and therefore the only thing left would be the permanent accounts, your assets, your liability, and your permanent owner's equity accounts.
So accounts payable and receivable are closed out when you have your,
They're not closed out.
They're not.
You don't close those out. They're permanent.
oh,
Because
those are permanent.
those are permanent, because on December 31st, if your fiscal and calendar year end that day, and you have accounts receivable of, say, $30,000, that
Well, that's true.
doesn't stop, that doesn't cease to exist January 1st. The family, in this case, the funeral home would still owe you that money. That doesn't get, your revenue based on accrual accounting would have already been,
Oh, that's closed out.
yeah, revenue and expenses, your temporary
Right,
accounts.
alright.
A prepaid expense is actually an asset. It's when a company prepays an expense for the entire year. Electric, insurance, rent, whatever it may be. 26. The difference between prepaid insurance and insurance expense, like I said, the prepaid insurance account is an asset and the insurance expense is a temporary account that is closed out like all other expenses. Prepaid expense is a real asset. Number 27. Why? You could read that once again as review, but the basic fundamental definition of anything prepaid is that, think about your car. We all have cars, or at least a car if bought a car. You pay for insurance, say January 1st for the entire year, okay? You get it, that's your money to use up on a monthly basis, okay? When you use it up, it becomes quote unquote expensed. So then at the end of January, you have used 1 month's worth of insurance. You decide to get a new car, well, you don't lose that insurance, you haven't used it, you get it back. So that's how it's an asset. It's an asset for you to use up. And then as you go, you expense it. 28. The entries that must be made to close out expenses and revenue accounts. Expenses normally carry debit balances, therefore to close them out you have to credit them, therefore debiting income summary. Revenue has a credit balance, therefore to close it out you have to debit it, and therefore you credit income summary. All you're doing, transferring your credit balances and revenue to the income summary account, transferring your debit balances and your expense accounts to the income summary account. 29. What account is the balance in the income summary account then closed out to? The owner's equity or capital account. So you close out your revenue and expenses to income summary, and income summary to the capital account. And think about it, if you have a credit balance in income summary, meaning you transfer more revenue than you did expenses into the income summary account, you'll have a credit balance. What do you have to do to close that out? You'd have to debit it. If you debit that and you close it out to capital, what do you do in the capital? You're crediting it. And what do you do in the capital essentially when you credit it? You're increasing it. So you make money, you increase your net worth or your capital. So go through this whole process. It's like a 5-step process to go through it. You could memorize it for sure, but if you actually know it, you know a 5-step, you know 5 questions, different answers as you go, just by knowing the process instead of memorizing it. Number 30, what account is never seen on a trial balance in a balance sheet? That's income summary. Income summary is opened and closed before it appears in any financial statement. Once again, 31 and 32, we kind of touched on it, but if the income summary is left with a debit balance, there's a loss. If the income summary is left with a credit balance, there's a profit. Remember, you're just transferring revenue and expenses to the income summary account. Therefore, if you transfer more credits in the form of revenue, you'll have a higher credit balance, or you'll have a credit balance, which means you have a profit, because your revenue is higher than your expenses. If you transfer more to the debit side in the form of expenses, you're going to have a debit balance, and therefore your expenses were higher than your revenue, and therefore you had a loss. What is a drawing account? It is an account that the owner of the company takes a salary out of. Be careful, the word salary is not perfect there. It's really just a way for the owner of a sole proprietorship and partnership, number 34, to take funds out of the business. It's not technically classified as a salary.
But it's supposed to be used to pay the owner of the business, right?
Yes.
I understand.
Yeah, but it doesn't technically go down as salary. Salary, in theory, is an expense, which is not technically different than drawing account, okay? So just, you would never be asked to distinguish between the two in the real world.
Okay,
And once again, this is kind of becoming dated because you could incorporate yourself or have an LLC or an S corp very easily now, where it used to be more complicated. But in the years ago, when sole proprietorships, partnerships were real, actual things that were common, or much more common than they are today, you probably had this. So salary is not the right word, it's just withdrawing of funds. 35, will a corporation ever have a joint account? The answer is no. Sole proprietorship and partnership are the only types of business entities that have a joint account. Why doesn't it have a joint account? Well, a corporation is a separate entity, and the stockholders, and has stockholders as owners, and even if someone owns 100% of the stock of the company, that person will receive a salary. So if it's a corporation, the corporation has a separate tax ID than the individuals who are salaried employees. Even if Donald S. Simber Jr. Funeral Home is owned 100% by me as a corporation, and I am the only employee, I'm still taking a salary and filing a personal tax return and filing a separate tax return for the business, so we're two separate entities. How is the drawing account closed out? You debit the owner's equity account and credit the drawing account. So you close out revenue and expenses to income summary, and if you have a drawing account, you close out the drawing account and the income summary account to the capital account or the owner's equity account. That is pretty much very basic accounting one information. Do you have any questions on that, or besides anything we may have, or if you want to expand on anything we spoke of? Okay. Number 38, what is the name given to the periodic allocation of cost of real property, personal property? Depreciation. What is the name given to the periodic allocation of the cost of natural resources such as minerals? Depletion. What is the name given to the periodic allocation of cost of intangible assets such as patents or goodwill? Amortization. Although depreciation, depletion, and amortization deal with different types of assets, are the entries the same to record these expenses? The answer is yes, and we'll go over that shortly. Before one can calculate the amount of depreciation, one must estimate what the value of an asset will be after all the depreciation is taken. What is this called? This is salvage value. It's an estimate of what your asset's going to be worth at the end of its useful life. It's something you just don't make up. It's something, even though it is kind of a guesstimate, something you sit down with your accountant and he or she determine what assets of that nature are typically worth by the end of their useful life. 43, on various financial statements, the asset is shown with the accumulated depreciation deducted. The difference between the cost and the accumulated depreciation is called book value. So book value is essentially the cost of the fixed asset or the cost of the asset less accumulated depreciation. 44, what is the entry that is made every year to reflect the cost of depreciation, depletion, or amortization? You debit the corresponding expense and credit the corresponding accumulated account. 45, on the trial balance, you'll have both the expenses for depreciation, depletion, and amortization, and the corresponding accumulated accounts. Which one of these accounts is closed out on a yearly basis, and which account is retained until the asset is disposed of? Like all other expenses, the depreciation expense, depletion expense, and amortization expense will be closed out. How do you keep track of it? You keep track of what you've accumulated in this accumulated account, this contra account. 46, the entry in relation to depreciation, depletion, and amortization that is made at the end of the year when the income statements are being prepared, just like every other expense. Debit income summary, credit the expense. How is the asset, number 47, being depreciated presented on the financial statement? You would have the asset less the accumulated depreciation and your book value. So your book value is the value that you're using to confirm your equality between assets and liabilities and owner's equity. You're not using the assets acquisition cost, you're actually using the book value. 4 methods of calculating depreciation are straight line, double declining or declining balance, sum of the years, and the units of output method, should say units of output. 49, straight line depreciation is calculated by acquisition cost minus net salvage value divided by useful years in life. That will give you an annual depreciation expense that is a constant for the life of the asset. Once a year you will make this entry and it will be the same for the life of the asset. Number 50, the two accelerated methods of depreciation are the declining balance or double declining balance method and the sum of the years. The rationale behind permitting accelerated depreciation. It is believed that many assets lose the majority of their value at the beginning of its use and not an equal amount over a period of time. With the accelerated methods of depreciation, expenses are higher when the asset is first put into service. If you're ever questioning this, think about your car, right? Your car depreciates by 30% the minute you drive it off the lot. That's the best way to describe it. But also when you think about it this way, when you're buying an asset, you're going to have some sort of reasonable cash outlay. It's a building or it's a car, especially cars in our business that are expensive. They'll have a big cash outlay. By accelerated depreciation, you're getting an expense, a non-cash expense. So in theory, you're accumulating that money, putting that aside for the next big purchase, okay? So there's another benefit to it, not just a real world benefit, but there's also an actual cash flow benefit to it. By depreciation, depletion, amortization not being cash expenses, when we talked about when you pay an expense, you're paying it. You're getting the benefit of an expense that's reducing your net income without paying out cash. So there's another benefit to it. What is an account designed to accumulate totals to offset a related account? That's a contra account. The accumulated depreciation, depletion, and amortization accounts are contra accounts. Why are they considered contra accounts? Because the balance in the accumulated account is retained on the balance sheet in the trial balance until the asset is disposed of. During the time the asset is owned, the balance in the accumulated account is used as a deduction from the asset. We saw that, how it's viewed on the balance sheet. Once again, the difference between cost and the accumulated depreciation is book value. 56, type of asset that is not depreciated, land. Land is never depreciated. 57, when a major improvement is done to an asset such as a new roof or a new air conditioning system, what is done with the cost of the improvement? Read it through, but think about it as you buy a building for $1 million, you realize you need a roof for another $100,000. So now your $1 million investment became a $1.1 million investment that you didn't think of. But by rule, the IRS says you can depreciate the $1.1 million because it's a capitalized cost. It's a cost that's been added onto it. So you can depreciate the 1.1, not just the 1. 58 is the actual, what is it called when you add the cost of major repair to book value? Like I said, a capitalized cost. Which depreciation methods do not take into consideration salvage value when calculating the yearly depreciation, depletion, or amortization expense? The double declining balance method. What you're doing is you're depreciating 40%, typically 40% per year of book value. So you're adjusting your book value every year, and that's the number you're depreciating 40% from. Number 60, what is the banker's method of computing interest? It's calculating interest using a 360-day year as opposed to a 365-day year. Why is it done? It's done because it evens out the days per month. So 360, 30 days, a month for 12 months. The formula to calculate interest is principal times the interest rate times the number of days divided by 360. So calculating the interest on $10,000 for 3 months at 10%, $10,000 times 3%, so 0.03, back to our fractions and percents from elementary school, 0.03, and 3 months, 30 days a month is 90 days. So 3 months, 10,000 times 10%, I'm saying 3%, it's 10%, I'm sorry to confuse you. 10,000 times the interest rate of 10%, so 0.10, times 90 days divided by 360. 10,000 times 10% is $1,000. 90 divided by 360 is 1/4. So 1/4 of $1,000 is $250. Remember, don't be scared of numbers that you may see. You could see 45, and wait a second, I can't do that math anymore. But 45 is half of 90. So instead of 1/4, it's 1/8. If you see a weird number, don't panic. Look at that. it's gonna be based, it should be based, easily divisible by 360. 63, what is an unwritten promise to pay customer at a later date for goods sold or service rent, account receivable? We saw that before. This is just putting all of them together. A written promise of a customer to pay the business a sum of money at a future date is note receivable. Remember, written versus unwritten, note account. An unwritten promise to pay creditors for property, account payable. A written promise, 66 should say written promise to pay a creditor a certain amount in the future, note payable. I just want to highlight those definitions. You could talk yourself in and out of answers with those definitions because they kind of tend to be very close. So just review those definitions. 4 methods of inventory valuation are average or weighted average method, LIFO, last in, first out, FIFO, first in, first out, and specific identification. 68 is a typo, just so you know. The formula used, what is the formula to use the average or weighted average method? It should be total cost divided by total units available for sale. That'll give you your unit value.
So it's the same terms with the
The,
other way
yeah,
around.
the numerator and denominator are flipped.
Okay.
69, what is the next or final step in determining inventory value when you use the average or weighted average method? Take a physical count of the inventory and then multiply the number by that unit value. Number 70, the LIFO method of inventory valuation means you're pricing your inventory by your oldest purchases. Okay, so LIFO essentially means the last ones in are the first ones out, meaning the last ones you purchase are the first ones you sell to your customer. So that means what's left over, the inventory, are your oldest purchases. With FIFO, the first ones in are the first ones you sell. So therefore, the most recent purchases are what will be left over, if anything's left over, when you're calculating ending inventory. How do you calculate cost of goods sold? You take the beginning inventory for the period, add purchases, subtract returns, and subtract the ending inventory. That gives you your cost of goods sold. 73, what is gross profit? It's revenue minus cost of goods sold. That's gross profit. '74. Does a rising or declining market affect cost of goods sold? Yes, it does. The inventory method used and the direction the market goes could very well affect the amount of profit earned. What is the effect of a rising market? Using LIFO in a rising market, you'll have a higher cost of goods sold because prices will be increasing and therefore you're selling your most recent purchases first. The last ones in or the first ones out. So they cost you more, therefore you have a higher cost of goods sold. Using LIFO in a rising, using FIFO in a rising market, you'll have a lower cost of goods sold because the ones you are actually selling, the first ones in, that are the first ones out, were less expensive. And 76, not to be like this, but it's just the opposite in the declining market. And I kind of, number 7, why does a rising market affect LIFO and FIFO the way it does? I pretty much just stated that. And 78 as well. So just review those answers. 79, the most accurate of all inventory methods is specific identification. Number 80, how does it work? Every item has a cost and you count the item and combine it with a price and add it up. What types of items is specific identification used? Big items, big ticket items. Cars, artwork, handmade goods even, caskets and vaults, typically big ticket items. The difference between gross profit and net profit. Gross profit is revenue minus cost of goods sold. Net profit is revenue minus cost of goods sold and all other expenses. Okay, so gross profit in a retail business refers to your profit strictly on merchandise. Net profit is everything else included. And number 83, when a retail company that buys goods for resale purchases goods, what account does it debit to record the purchases? Debits his account called merchandise purchases. This is the moment in time where I suggest taking a few-minute break to, clear your eyes because they start to tear a little bit from the debits and the credits and the rising market and declining market conversation.
Yeah.